Breaking news. Gold shatters $2,000 as barrier on October 20, 2023. Have central banks lost control of the gold price? A Metaquant 4D perspective. In a shocking turn of events, gold prices have surged past the elusive $2,000 per ounce milestone, leaving the financial world both awestruck and bewildered. This meteoric rise has sparked a flurry of questions, but one echoes louder than the rest. Have central banks lost their grip on the precious metal's value? As our readers may recall from our report in March 2023, we hinted at a paradigm shift in the gold market. Traditionally, gold prices were influenced by real interest rate expectations, energy prices, and central bank policies. These factors allowed for predictability and convergence of prices. However, recent developments have thrown a wrench into the established order, driving a wedge between actual and model-predicted gold prices. The model breakdown. A recap. Historically, rising interest rates were accompanied by declining gold prices. This inverse correlation was due to real interest rate expectations, which influenced gold prices significantly. The surge in gold prices in 2022 was cushioned by the simultaneous rally in long-dated oil prices, masking the initial dip. New realities emerge. The astounding revelation is that gold prices not only defied the expected downward trajectory, but soared well above our model's predictions. The staggering $668 deviation from the model's projection leaves us astounded. Gold currently trades at $1,870, far removed from the predicted $1,202. In our March 2023 report, we explored various theories to explain this stark discrepancy. One plausible explanation was the unprecedented buying spree by central banks, particularly non-OECD countries, which seemed underestimated by conventional estimates. This robust central bank gold buying activity drove gold prices higher, but the tides have since shifted. Despite recent fluctuations, central banks' net gold purchases in 2023 have not exceeded historical averages. It seems the central bank activity, while influential, does not solely account for the ongoing gold price surge. The real interest rate riddle. A second observation unveiled the disintegration of the age-old relationship between real interest rate expectations and gold prices. This breakdown occurred as the Fed raised rates, pushing 10-year TIPS yields sharply upward. While gold and real interest rates had traditionally moved in lockstep, this correlation crumbled. Inflation expectations, as reflected in TIPS yields, remain surprisingly low despite substantial price inflation elsewhere. A shocking revelation. Lost control. In an intriguing twist, we believe that Western central banks have simply lost control over gold prices. Previously, it was widely understood that central banks had the power to impact gold prices indirectly. However, the recent disparity between gold's behavior and the Fed's rate hikes suggests that this power has waned or even vanished. Rather than central banks losing control over gold prices, it may be more accurate to say that they have lost control over their own currencies. Gold, historically a store of value, seems to be the only currency holding its ground in this uncertain world. As other currencies fluctuate wildly against each other, what lies ahead? The future remains uncertain. The Fed's rate hikes may temporarily curb inflation, and a global recession could even lead to temporary deflation as commodity demand collapses. However, previous monetary policies have left an indelible mark, and the central banks are not on the path of a significant quantitative tightening. The enduring appeal of gold as a neutral anchor in a volatile currency landscape is evident. As uncertainty about currency values persists, more and more individuals are flocking to gold to safeguard their wealth. Conclusion. A new normal for gold. In our previous analyses, we speculated that the deviation of gold prices from historical norms might be permanent. It seems our predictions are coming to fruition, with foreign central banks increasingly boosting their gold reserves and true inflation expectations staying high. This, coupled with the impending return to zero and negative interest rate policies, ZIRP, NIRP, and further rounds of quantitative easing, QE, is likely to cement the shift in power from central banks to the enduring stability of gold. As the dust settles and the financial world grapples with these new realities, the questions surrounding gold's future are far from resolved. Will central banks regain control, or is gold destined to reign supreme in a world of economic uncertainty? Only time will tell.